This last week in Vancouver, we saw the MultiPlex Plan get approved and pushed forward, essentially effective immediately. And then on top of that, the federal government went ahead and essentially removed all GST on the construction of new rental house building. So tinker as they might and try as they might, does this government intervention into housing actually help or does it hinder? Well, we're going to do a dive into that today and also talk about, well, we certainly need some kind of support because investment into new real estate and building permits are sitting at about 20-year lows, setting up a dramatic and further crisis in our inventory shortage here. Inflation also rose, and well, all bets are now currently on a further rate hike. And yeah, that made me cringe just saying it out loud. So let's dive into it. Let's see what's happening this week. Another quick moving week of activities in the real estate market. If you don't know, me and Ryan, we are real estate agents here in Vancouver. We run a team and we help people navigate this market. So if you want to know what's going on and how it affects you personally, we're more than happy to chat. Just reach out to us at the Calendly link below. Okay, let's talk MultiPlex Plan. As I mentioned, this was approved last week, and we tried to do a bunch of research on this, but unfortunately, the City of Vancouver website has zero updates on this as far as what has actually gone through with the finite details, but let's share what we do know. So it was Thursday of last week, Thursday, September the 14th, the MultiPlex Plan was approved by City Council. And this essentially takes all the single family zone properties across Vancouver East, Vancouver West, and is a blanket rezoning allowing people to now redevelop 3 to 6 units, or they'll even do a density bonus up to 8 units if you're doing rental properties only. And of course, you do have to have the lot size to support that. Essentially, they've got now a max density of 1.0 floor space ratio, and that's for all the full assortment of the configurations, and they do allow up to 3 stories in height here. So what's FSR mean? Well, if you're sitting on a 4,000 square foot lot, that means at 1.0, you can build a 4,000 square foot building. So pretty simple math there for people to understand what could potentially be built. And one great thing about this too, of course, is that now these rental suites can be built above ground. So you're getting people out of basement suites into basically at least ground level suites. So that's definitely a bonus there. They are kind of cleaning up or simplifying, if you will, all the RS zoning differences that are out there right now. Like there's, I think, 9 different residential zones within Vancouver. So they have now consolidated those down to a single one. It's called R1-1 residential inclusive zone. Great. Very pro all of this. This is really going to help with new housing and also help with the process, right? If you don't have to go and rezone your property to build something, well, you've probably just saved yourself 6 to 12 months in time of getting that new housing up and running. So how many lots does this actually affect? Well, again, we're talking about Vancouver East and West. It does not include areas like Kitsilano, Point Grey, Shaughnessy, UBC, for example, but it does obviously include the majority of the rest of Vancouver proper here, which equals about 65,000 lots are affected by this new zoning. So it's a significant amount of properties and lots that are effectively rezoned and allowed to be multifamily now. The regulations, it actually also reduces the maximum size allowable for new single detached houses, but it increases the maximum size for new laneway houses, and it also simplifies the laneway house regulations. Fantastic. Okay, so this is unquestionably a major move here in Vancouver. It's pretty much the largest land change we've seen in probably decades. And further to the announcement at council, there was about 60 people that had registered to speak in person here. And while we're very pro this, of course, there were some opponents that spoke their voice. Largely on the opposing side, people were concerned about infrastructure. Understandably, if it can handle it. Parking, yep, that's a big one to be seen, right? Obviously, if you've got a single family house that can now house up to 8 families, well, there's going to be a lot more cars in that on that block. So understandably, some people were raising concerns about what the parking might look like. And also some people were worried about essentially the older houses that we have being basically just demolished and replaced with new multi-unit buildings. Vancouver is pretty known for kind of just, tear down the old, put up the new. It does speak to the fact that, we do lose some of our heritage and essentially culture from that. So those concerns were raised. But all in all, it was obviously voted unanimously, and it has passed. So how many people are going to take advantage of this? How many homes can we see built? Well, previously we had heard about 100 lot test size that they were going to use. Again, no details out on that yet. I heard that there is a 500 application backlog right now for people that want to go and start building right away. That is unverified, so we'll see. At council, they had expected in and around 200 lots per year would actually be under construction kind of thing. So we'll see. But okay, let's run some math on that. So 200 single family homes turns into, let's call it an average of, 1,200 units or so over that 2-year time frame, for example. So that houses 700 people in the single family homes, now up to about 2,400 people. So that's a gain of, around 1,700 people now have housing on these same lots. Meanwhile, the city of Vancouver is growing at around 30,000 people per year. So, the simple math shows that we're not keeping up. And, it's not just 1,700 extra units. This is on top of all the construction that's there. But still, while it is unquestionably a direction or a path in the right direction here, it doesn't seem like it's going to even come near to equating the housing that we need. As CMHC said just last week, we could be short 3.5 to 4 million homes by 2030 at our current pace. So it's a good response, but it's not going to solve our housing crisis, and certainly not overnight. We also don't know, of these people that do move forward with construction of these multiplexes on these lots, how many will ultimately be for end users? How many will be rental units? It's unknown. They don't force that down either way, but this is all kind of to be seen as it unfolds over the future years here. I think a couple more unknowns is, again, is there a cap as to how many people will be allowed to build, or is it a free-for-all? How will the infrastructure be tackled for servicing this higher density? Where's all the parked cars going to go? And what's this going to do to schools? You know what I mean? Because, of course, if you increase the density around desired schools by 200-300%, we know these schools are already basically at their capacity for the most part, some with multi-year wait lists. Again, to be seen, but hey, overall, I'm taking this as a win. Ryan, how do you feel about it?
Yeah, listen, it's a move in the right direction, right? I think enough of these moves in the right direction will help to some degree. However, much like you said, I don't think it's the be-all, end-all answer of our housing crisis. It's a great move forward. I think we'll probably see a lot of major urban centers across Canada also doing this. And kind of another unknown, Dan, again, you keep piling people into, more and more density. Yes, schools will be overloaded, but, so will the healthcare system too. I mean, how many people are going to continue to go into higher density areas because of the convenience to go to work? But also there's one hospital or two hospitals that service that area. I mean, that St. Paul's Hospital can't be built fast enough at this rate, right? So things like that, I'm all for this. But again, we're trying to tackle a 30-year problem here with some kind of overnight pen strokes. And that's just only part of the problem. So anyhow, speaking of pen strokes, I'm going to touch on the federal GST rebate here. Which I think is a bit of a knee-jerk reaction. Generally speaking, the Liberal government's been under a ton of pressure. And I think this is sort of how they're reacting to it, at least initially. And I'm not quite sure it's going to pan out. I think it'll help incentivize in some areas, but generally speaking, we'll see. So on September 14th, the Prime Minister announced the GST rental rebate on new purpose-built rental housing. This is to incentivize the construction of much-needed rental stock, and it will only apply to new purpose-built rental housing. So new apartment buildings, student housing, senior residences for long-term rental accommodation, those types of things. The enhancement will increase the GST rebate from what is currently 36% to now 100%. This will apply to projects that begin construction after September 14th of 2023. So to be clear, and it will go until 2030, the end of the year 2030. Any construction project to take advantage of this must be completed by December 31st, 2035. So there's a 5-year window there if you start construction right at the end of this. And then it appears like at the start of 2031, that tax will come back. And let's be honest, once a tax is introduced, it almost never goes away. So buildings that will qualify. So 4 private apartment units or at least 10 private rooms or suites, 90% of residential units designated for long-term rental. So projects that are converting existing non-rental real estate, such as office buildings, residential complexes, they would be eligible for an enhanced GST rental rebate if all of the above conditions are met. To protect Canadian renters from rent evictions, because I could see this being an issue, the enhanced GST rebate will not apply to substantial renovations of existing residential complexes. This is intended to stimulate new supply and not take supply off the market. I don't agree with this particular piece. I think a large portion of our rental stock comes from mom and dad's basement suite. And if we can't add mom and dad's basement suite to the rental stock, that's like a character flaw of this entire idea. I'm just struggling with that being fair, because at the end of the day, the builders will simply pass that either on to the buyer. If they do not get the 5%, that 5% will go on to the buyer. And if they do get the 5%, then the builder will then pocket the 5%. So does this really benefit the buyer or end user? I'm not sure. And I also feel like 5% GST is not enough of an incentive to build more rental stock. If I get 5% back, let's just run the math like you said, Dan. If I get 5% back on the rental construction or on the construction of a $1 million condo, for example, so call it $50,000, right? And that $1 million condo is, say it's $3,600 a month in rent, right? So I have to wait as the builder. I have to rent this thing for 2 years before I'm going to see the return of my 5%. However, my incentive to build that unit, it doesn't even compete with taking it to market and selling it, passing on the 5% to the end user so that person can go rent it. So for me, I'm not sure there's enough incentive here. Dan, what do you think?
Yeah, they love to tinker, right? The government is trying something. It sounds good on paper. And sure, from the builder side, knowing that their margins are so thin these days, a potential 5% buffer there, it really does help them in that sense. But yeah, of course, is it enough incentive? And interestingly enough, the book I'm currently reading is called Economic Facts and Fallacies. And a big part of this book touches on, of course, real estate, where they made a point here of saying, look, at the beginning of the 20th century here, before government intervention into housing became so pervasive, people were paying a much smaller percent of their expenditures for housing. Okay, this goes back over 100 years, where in 1901, the average expenditure was 23%. Jump forward to today, it's 33%. And then, of course, there's, they get a little bit deeper here. They talk about like the Bay Area in San Francisco, where in 1970, very similar. And before government intervention, people were averaging about 25% of their income went to their housing, and their mortgages were paid off in an average of 13 years. Governments got involved, and in a very short 10 years later, that had already jumped to a 40% of their income, with mortgages being paid off in 30 years, 30. And we jumped to today where it's now 50%. And I just want to read one quick little piece here because it really speaks to, I think, what's even happening here. In most cases, the decade in which housing markets became unaffordable closely followed the approval of state growth management laws or restrictive local plans. So this is a global phenomenon. They did an international study of 26 urban areas with quote unquote severely unaffordable housing and found that 23 of those 26 areas had smart growth policies, meaning government intervention. So the results obviously belie the phrase. And it's almost like, yeah, they're in here and they're trying to do things to fix housing, to make it affordable. And yet it looks like the best thing the government could do is just nothing. Just stop, walk away, let the market be a free market again. Now, that's a pipe dream, I'm afraid, at this point. But again, so much of this tinkering is almost just lip service and, policies pushed through to keep them in power. So that's my thought.
You could very much say the same about money supply. Stop tinkering with the money supply. If you stop tinkering with the money supply, yes, some businesses would fail. The ones that took too big of risks, they'd fail. People would go out of work, but they would find something else, right? And something else would come in its place, something more competitive, right? I mean, I'm a free market capitalist, so I personally believe that government intervention usually complicates things. It doesn't simplify it, and over time, the demand for certain products or asset classes will persist, right? And for example, with the GST rebate, they don't want mom and pop who own their basement suite doing it because they feel like it could evict someone. But what if I want to take advantage of this GST rebate and build a suite and add to the rental stock, but I don't get to take part in this, right? Like, a free market would allow for that to take place, and the government wouldn't step in, and the market would control the demand factors. So there's too much control. There's too much fingers in the pie here. And, that's probably never been truer than when we discuss inflation, right? And inflation, as we know, for the second straight month was a bit of a surprise to the upside, more so than they were anticipating for August. CPI rose to 4%, up from 3.3%. It's considerably higher than the 3.8% they were expecting. And looking ahead, we have likely one more inflation acceleration in September before it could cool in October. Maybe. We'll see how this plans out. But here's the thing. Even if inflation averages a 0.2% monthly increase from here, we will end 2023 at north of 4%. And as far as I'm concerned, that, and probably the Bank of Canada, that will be too high for them to leave it untouched. So, what are we focusing on this week when it comes to inflation? Well, the narrative keeps changing, right? The majority of inflation was driven by energy and food prices. And if you noticed, maybe over the last 3 to 6 months, we were talking a lot about core inflation, which actually removed food and volatile energy prices. And now we're back to talking about headline inflation, which includes it. So which one are we talking about? What are we focusing on? And it's more evidence, if you will, that the government sticks their finger in and puts your attention on whatever it is they want, instead of just dealing with an actual policy intervention that could help with energy or help with fuel or help with food. I mean, we're only waiting until now where, Trudeau has summoned the top 5 grocery companies to talk about how to control prices. How have we waited this long? Are we not going to call the energy people too? Or, are we just going to let that go? It's so inconsistent. It just makes me feel like there's no plan really to deal with this, which is a little scary. So if rates rise again in October, I think we should be prepared for a potential recession, right? Because that will be a tipping point. And if we get 0.4% per month on average, we'll be back above 5% inflation by November. So how are the markets responding to this? Well, this seems to change every week, Dan, but they're now pricing in a further rate hike by Q1 next year, and they are no longer expecting any rate cuts for 2024. But I feel like every time we look at the data, this narrative changes because whatever the government wants to look at changes. And we can't just keep taking the blunt hammer of interest rates to specific items like energy and food and expect that lever is going to fix this without destroying everything else in its path. And that's where I just don't agree with consistently raising and raising and raising. Why are we not looking at policy measures that will actually help to reduce inflation in these areas, like carbon tax. Why are we adding carbon tax right now to fuel that's surging in price? I don't know.
Yeah, it does change, like you mentioned, basically every week. Though I will say, I think this is the first time I've seen the markets price in no cuts in 2024. So we'll see how that looks next week. But at this point, it's that higher for longer sentiment, and this is going to continue to bleed people out. And it's important to note too here that the states, they can basically last longer than Canada at these rates. And what I mean by that is when we look at like the household debt ratios, US's debt ratio or debt service ratios are like 9%. And you compare that to Canada's at 15%. So we're so closely tied to interest rates in the States that we can't really move or detach much from where they are. And yet again, if America can kind of outlast Canada, if you will, because they're not going to see things break as hard or as quick as we are, it's setting up for a bit of a disaster here, because of course, we can't see rates just drop super quickly and kill the dollar, etc., because that has other ramifications. But either way, it is a tricky landscape right now, and we are all in the thick of it. Understandably, it is obviously deeply affecting mortgages. And we did see the Feds hold rates last week. Even though their inflation is rising, they did hold rates. And that up north, sent our 5-year bond yields absolutely spiking. It hit as high as 4.28 this week, which has resulted in fixed rates going up. We're going to see fixed rate mortgages increase about quarter point to 0.3% likely this week, if not early next. And that's hurting, right? That makes the landscape even harder. That makes purchasing power decrease even further. And obviously we're seeing, the average monthly payment increase even more so. We've actually hit a fresh new high. So if you were to go out and buy the typical average Canadian home right now and get your 30-year mortgage with 20% down payment, well, your mortgage payment is now $3,600 a month. Let's go back 2 years. If you can believe it, it's 80% higher than it was just 2 years ago. And we're up 21% year over year. Just an absolutely staggering number. So new mortgage growth, people going out to apply for new mortgages, is basically falling off a cliff here. So mortgage growth on an annualized basis, it's the lowest dating back to 2001. It's a 22-year low, growing at the rate at like 3.5% year over year. So that rate of growth equals basically, well, it's actually lower than it was post B20, post stress test that we saw in 2019. So it is very slow out there for new home purchases. Even with these high rates, though, interestingly, people in arrears are still basically at near rock bottom. We did not see the mortgage arrears rate change month over month from June to July, and still sits at almost near all-time low of 0.15% nationally. And again, it's even lower here in BC at 0.12%. Well, great that people are paying their mortgages, but where we are seeing further stresses are, of course, in credit card debts and consumer insolvencies, because consumer insolvencies jumped a whopping 21% year over year, which is huge. But of course, because of the low baseline effects, we're still 10%-ish below pre-COVID numbers. But you look at the trajectory, and it is going to shoot way past that and go above that in the next coming quarter or so. On the flip side, though, when we talk about debt, let's talk about assets, because the other side of that coin is that right now, Canadians still have a fair amount of assets. For every $1 in debt, the average Canadian has $6.50 in assets. So they're far from being underwater in that sense. Now, some of the businesses, though, they're not faring quite as well, where we saw business insolvency filings jump 49% year over year. This is a 6-year high right now. So it is absolutely spiking. And so businesses are in trouble. We know that, right? Especially because of their lending rates have jumped so much. So you're going to start to see that unemployment number tick up in the coming months for sure. And again, while people are paying off their mortgages, their credit cards are getting flexed right now, because we saw credit card lending jump another like 1.4% in July, and we're up 7% over just the last 6 months. People are clearly using their credit cards to stay afloat here. And, these are high interest rate credit cards too. So that is going to continue to add pressures on people. We're going to see a lot of spending pull back. We're going to see GDP drop. And it's no wonder here that we're seeing consumer confidence. It dropped, like when we measure the consumer confidence index, it dropped 12.5% last month. It is now sitting at the lowest it has been since the depths of COVID, like April 2020, when we were locked in our houses, and the global financial crisis. So the sentiment, the confidence consumers have right now equals when we were locked in our houses in COVID, not knowing if half the world was going to die, and the depths of the global financial crisis. So when it comes to sentiment, it is essentially as low as it goes. And that will, again, keep people from spending, from dining out, from going on trips, all that stuff. So expect lower spending overall, and GDP to definitely drop in its wake.
Pretty interesting information there, Dano. I mean, when I look at this too, $6.5 for every $1 of debt. I guess what that looks great from an asset perspective, but from a cash flow perspective right now, I'm sure that that's quite painful. So it's whether or not that'll maintain. I suspect that'll erode if rates remain higher for longer. And speaking to immigration now, some more incredible numbers. Temporary worker admissions has just surpassed 1 million people on a 12-month rolling average. 1 million. In 2019, for example, it was 350,000. International student admissions are now at 625,000. Again, in 2019, it was about 350,000. So that's about 1.8 million combined in the past 12 months. However, I just want to bring this up because everything that we just talked about, all of these potential people that are coming here either for school, for work, they're going to be met with a huge amount of challenges. And I guess my question is when they get here, first of all, are we ready to support that level of change? And two, are they prepared for the extremely high cost of housing, fuel surcharges, taxation, everything else that comes with it? I guess what I'm getting at is, are immigrants going to really be realizing the dream that Canada had once offered? We're going to be looking at schools that are stretched to their absolute wit's end. We're looking at healthcare that is sometimes multiple days waiting in an ER room before you actually get seen. How are we going to deal with some of these issues, right? I don't know. It's unbeknownst to me. It hasn't really been explained how we're matching the infrastructure to deal with all of this change. So I don't know how long, if some of these people come here, are they going to dig their roots in, or are they going to realize in 2 or 3 years that this isn't what they thought it was going to be, and we'll see an exodus of people as well? I don't know. Dan, what do you think?
Well, the other big question, of course, too, is where are they going to stay? Because
that's right.
The reality is here too, when we look at the current investment, money being spent on new construction and people renovating, it has fallen to the lowest level in more than a decade and is now basically barely above where we were during the COVID lockdown lows. So think about that. When you couldn't leave your house, you couldn't build anything because you were trapped in your home, there's the same amount of money basically being spent on new housing today. That is incredibly low. When we look sure, if you remember the highs of 2021, when everybody was building and everybody was doing renovations and there were big lineups at Home Depot, well, we're down 45% since then. And realistically, this is absolutely disastrous for our long-term supply picture. Because yes, while there are a lot of homes under construction right now, that has just rolled over for the first time in I think a decade here, meaning that it's now slowing down. We're just starting to see it. We knew it was coming. Well, now it's rolling into the data here. People that are renovating their homes too, that's under serious pressure. It's down 30% year over year. So people, again, we know they're stretched, they're paying their mortgages, but they're not using their extra money here to do any kind of home improvements. So just similar to new construction, I mean, that segment of the market is basically down as low as the COVID lockdowns and financial crisis as well. So Home Depot, you're going to see those earnings definitely drop off as well. So the number of new dwellings, like I mentioned, across the country, while we basically just fresh off of all-time highs, it did come down about 1.7% in August here. And interestingly, that's actually the largest decline we've seen in 7 years. So it is moving quick. Of course, this is the first downward trend we've seen, or downward mark we've seen in some time. We're going to keep an eye on this, but we know because the permits are so low that this downward trend is likely to continue. And we're talking at least the next 6 months minimum. So we're going to see that start to affect the construction jobs industry as well. Again, further unemployment ticking up, and you can just kind of see where this is going. It's screaming recession here as well.
Yep.
Yeah. So when it comes to new housing, it's just not coming anytime soon here. Even, yes, we've got these great incentives from the government. That's going to take some time to filter through here to change this data that we need to change ASAP.
Yeah. And based on that too, looking at active inventory, with affordability at current highs, historical highs, inventory is climbing because people can't afford to buy anything. Right. So in Ontario, for example, it's up 6.9%. And in the last 3 months, it's up 24%. Ontario has entered into a buyer's market overall. That's staggering. Here in the GVRD too, inventory is up 14% in the first 3 weeks of September. And we talked about in a couple podcasts ago where single-family homes had entered a balanced marketplace. Remember that single-family homes typically lead the real estate market. So, if we're seeing that enter a balanced market, chances are if it goes into a buyer's market, you'll start to see townhomes and duplexes move into a more balanced side and then condos to follow. So I don't know, Dan, it's not a very rosy picture right now. In many ways. And I think there's a whole lot more problems than solutions. And I think our government really needs to realize that pen strokes are not the answer here. We need fundamental change.
We do. And I think for anybody who's been out there trying to buy a home and you have not liked the landscape as far as what's been available, and knowing that it's basically been in a seller's market for all of this year, it does look like we will be entering in a balanced market here in September. So things are changing. Again, obviously prices are where they are and interest rates are where they are, but we're starting to see at least more options for people that are looking to buy, that are pre-qualified, that do feel like now is the right time for them. In that sense, it's trending in their favor, but again, it's certainly not going to feel very favorable out there right now. But either way, we're going to see continued inventory increases by the looks of things here as the pressures continue. So I think that's a good place to wrap it up. Thank you, as always, for tuning in. We will see you again next week.